Hello, my name is George, and in this video, we're going to talk about how to invest in gold for beginners. If you've ever wondered how gold works as an investment, why people trust it, and how you can get started, this is for you. You'll understand the different ways you can invest in gold, the pros and cons of each one, and how to figure out what might fit your goals. If by the end you decide this makes sense for you, I've listed the top rated gold IRA providers along with any special promos they're currently offering. To check them out, click the first link down in the description of this video. It's an affiliate link which helps support the channel at no extra cost to you. Now, let's get started. Why do people invest in gold? Gold is one of the oldest and most trusted ways to protect wealth. It has been used for thousands of years across different countries. You can't just print more gold like you can print more money. It's rare and people trust it. When the economy is shaky or inflation rises, gold tends to hold its value. It's not like stocks or real estate. You won't get income from gold. It won't pay you dividends or rents. But when things feel uncertain, gold gives people peace of mind. That's why during big financial problems like the 2008 crash or the COVID-19 pandemic, the prices of gold jumped. People rushed to it because they saw it as safe. What does it really mean to own physical gold? When most people think of investing in gold, they think of holding the real thing. That means coins or gold bars. It's simple. You buy it, you hold it. There's something powerful about having a real gold coin in your hand. Coins are a good starting point for beginners, easy to store, and they come in different sizes. There are coins that are well known around the world. That means when you want to sell, it won't be too hard. Gold bars are another option. They can be more cost effective because they usually have lower extra costs added on top. But they're not as convenient if you're only starting with small amounts. And here's something you need to know. You don't just pay the market price for gold. There's something called a premium. Let's say gold costs $1.8 thousand per ounce. You'll probably pay a bit more, maybe $1.9 thousand. That extra cost covers things like minting the coin, shipping, and the seller's fee. It's normal, but you want to make sure you buy from trusted sellers. Where should you keep your physical gold? Once you own gold, storage matters. Some people keep it at home in a safe. Others prefer bank safety deposit boxes or private vaults. Each option has its risks. If it's at home, make sure you've got proper security and maybe insurance. If it's at the bank, you're paying storage fees and access might not be immediate. You have to weigh what makes you feel safe. What if you don't want to store gold yourself? If the idea of holding and storing gold feels like too much, there's another way. You can invest in what's called paper gold. This is where you don't actually own the gold itself, but you invest in something that tracks its price. The most popular way to do this is through exchange traded funds, also known as ETFs. An ETF is like a basket of investments you can buy on the stock market. There are gold ETFs that track the price of gold. When you buy shares of this fund, you're basically getting exposure to gold's price without having to hold the metal. There are also mutual funds that focus on gold. These funds are run by professionals who use your money to buy gold or shares in gold-related companies. They do the work for you. For beginners, ETFs and mutual funds are an easy way to start. You can buy and sell them through your broker, just like stocks. But remember, these funds charge fees. Those fees can eat into your returns, so make sure you check what they are. What about investing in gold mining companies? Another option is to buy shares in companies that mine gold. These are businesses that dig gold out of the ground. Mining stocks can move up when gold prices rise, but they also depend on how well the company is run. Good management and low costs can lead to profits. Bad management can mean trouble. There's more risk here because you're betting not just on gold, but also on the company's ability to operate. Junior mining companies, the smaller ones, are even riskier. If they strike gold, their stocks can skyrocket, but if they don't, the value can fall fast. This is a more speculative way to invest and probably not the place to start if you're new. Some mining companies also pay dividends, which can be attractive. But remember, the performance of these stocks is not just tied to gold prices. Things like debt, environmental issues, or political risks can affect them. Can you bet on the future price of gold? For more advanced investors, there are gold futures and options. Futures contracts are agreements to buy or sell gold at a set price in the future. Options give you the right, but not the obligation, to buy or sell gold at a set price. These are high-risk tools that can offer big rewards or big losses. Futures and options are complex and move fast. If you're a beginner, I'd recommend staying away until you really understand how they work. Is there another way to invest in gold that acts like currency? There's also something called a gold currency linked structure investment. This one is less common, but it works like this. You agree with a bank on how long you will invest and on a target rate between gold and your chosen currency, like US dollars. At the end of the investment, you either get paid in cash or in gold, depending on how prices move. This method can give you higher returns than just holding cash, but it comes with risks like market risk, principal risk, and liquidity risk. If the market goes against you, you could end up with less than you invested. It's also more complicated and needs regular monitoring. So again, not something for beginners unless you're ready to track those movements closely. How much gold should you have in your portfolio? Gold is not supposed to replace all your other investments. Most financial experts suggest holding between 5 to 10% of your portfolio in gold. That way, you get the stability gold brings without putting all your eggs in one basket. When the stock market falls, gold often rises or stays steady. This helps balance out losses in other areas. During the 2008 financial crisis, for example, when stocks took a huge hit, gold prices went up. But keep in mind, gold doesn't generate income. It just sits there, holding value. That's both a strength and a limitation. What are the downsides of investing in gold? Gold isn't perfect. First off, it doesn't pay dividends or interest. It's not going to grow your money actively. It's there to protect what you already have. If you're looking for big growth, gold might not give you that. Physical gold has storage and insurance costs. Selling it can come with taxes and fees. And if you buy ETFs or mutual funds, you'll pay management fees over time, and those add up. Gold prices also go up and down. Just like any other investment, there are no guarantees. So, is gold right for you? Gold has been trusted for centuries. It's not about quick profits or chasing trends. It's about safety and stability. If you want to hedge against inflation, protect your wealth, or diversify your investments, gold can help. But it's not a magic solution. It should be part of a bigger plan. Start small, take your time, learn as you go. Whether that means holding a gold coin in your hand, investing in a gold ETF, or buying shares in a mining company, make sure you understand what you're investing in. And don't forget, if you decide that this makes sense for you, I've listed the top-rated Gold IRA providers along with any special promos they're currently offering. To check them out, click the first link down in the description of this video. Thank you so much for supporting this video, and I'll see you in the next one.